Hey, it's Eric Powell with the Future Mill. Mutual funds have gotten a bad name in the financial industry. You've got some people that say you shouldn't invest in mutual funds at all, and then you do have people like Dave Ramsey who says buy for mutual funds. So what should you do? Well, let me give you a quick history lesson on how it all really started. Back in 1976, Vanguard opened up index funds. The index funds was an opportunity for people to invest in more of a passive investment, and that investment had a lower cost. So people already started to get the idea that they wanted to lower the fee in the fund. Then you fast forward to today, you have TD Ameritrade, Charles Schwab. All of these companies have cut trade costs. So people are really focusing on fees at this time and making sure that they are cutting fees. The idea behind that is that if the fees on the fund, such as a mutual fund or an index fund or an ETF, if they are lower, then you get to keep more money in your pocket with the performance. Now that makes sense in general, but sometimes a fund might actually beat another fund even with higher expenses. So what I want to look at is what exactly a mutual fund is. I want to break that down for you. Then I want to talk about the cost of the funds because there's a lot that comes into this with a mutual fund and the cost. We'll talk about the break points with mutual funds. Then we'll talk about the diversification because a lot of these mutual funds I have found don't have the diversification they need. But then also we will look at the actual performance and we'll look at a side-by-side if you invested in a mutual fund versus an ETF and see which one actually wins. Then at the end, I will give you my take. So to start it off, what the heck is a mutual fund? Well, a mutual fund is where a pool of investors, so if you and a bunch of friends all give your money to the mutual fund company, what they are going to do is buy securities such as stocks and bonds in a portfolio. They are going to manage that for you. And then any performance outside of their management fee is going to be passed down to you. Now, if that doesn't make sense, think of it like rental property. What you're going to do is you're going to buy a rental house with some friends. You're going to pile your money together, go buy that rental house. Then you're going to need tenants in the house. So what do? You're going to go hire a property manager. That property manager is going to charge you to manage that property, just as a mutual fund company is going to charge you to manage the fund. So what they're going to do is they're going to handle everything for you. It's hands off, but in the end, they're going to pass a lot of the performance minus the expense down to you, or with the rental property, they're going to pass down whatever rents come in minus the expense for the property manager. Now let's take a look at the cost of mutual funds. The American Funds Growth Fund of America Class A Fund is the one I want to look at. It's on a Morningstar report. So if you ever want to look up something, go to Morningstar. This is a great way to do some research for yourself to look at these funds. But if you're looking here, you have a 5.75% front-end load fee. Any Class A share mutual fund is going to have this front-end load fee if you are buying it on your own or if you are buying it with a commission advisor. Now, I even went and tested this because I have my own brokerage account through TD Ameritrade, and I went to buy this fund, and this is what popped up. It talks about that basically there's a front-end load fee, but it actually doesn't even disclose it. It does give you a link to show you that you can go to this other area and look at the different information, which is called a prospectus. Those things are usually this long, they're super boring to read, and nobody's actually going to read it. So make sure you know what you are paying for if you are buying into these mutual funds. Now, the ultimate goal here is with this, advisors are selling you this fund at 5.75% because if you give them $10,000, they are going to then charge you $575 on the front end. This is quick money for them to make, and then you are actually only going to invest $9,425 because the $575 went to the advisor. This is a problem. It is going to make you basically start behind already on your investment. You're going to have a much higher performance in order to get ahead. Now, the fund that I was looking at, the American Funds Growth Fund of America, this is just a random fund that I picked, but American Funds is a pretty popular fund, and that's why I picked this one. If you're looking here, though, they have the net expense ratio. Your net expense ratio is 0.64%. According to Morningstar, that is actually a little bit low when it comes to these funds. Now, everything has an expense ratio. ETFs, index funds, mutual funds. One of the big problems is oftentimes the mutual funds have a higher expense ratio on the back end because oftentimes they are also actively traded versus an index fund, and a lot of ETFs aren't actively traded, they're passively traded. Now, as far as this fund goes, if you go to the American Funds website, which is capitalgroup.com, you can see that there's different breakpoints in how this works. So you're going to pay 5.75% for the first $25,000 that you put in. Then you're going to pay 5% for $25,000 to $49,999, and then it continues to go down. Now, if you invest $1 million, which they really want you to do, then you actually don't pay any front-end load fee. But there is a catch there, because if you see the little cross right there, what it's going to tell you, I went down and read it, it's that if you pull out your money before 18 months, then they're actually going to charge you a fee, because they want to make money on this. When it comes to diversification with a mutual fund, you have to be careful, because if you don't know what you are buying, you may buy 100% stocks, but your risk tolerance may tell you that you should be 80% stocks, 20% bonds. So be very careful with this. When I was talking about the American Fund's Growth Fund, I want to show you the diversification with that. So if you're looking here, what we look at as advisors is actually the sectors, and we want to make sure that you're allocated properly across all the sectors. Now, this one's a bit heavy in tech, but also the S&P 500 is a bit heavy in tech. You're pretty heavy in healthcare, consumer cyclical, finance isn't too big, communications is really heavy. This is quite heavy for any fund. I know the S&P 500 isn't as heavy with that. So this just kind of shows you an idea of this pie and what it looks like when it comes to diversification. The ultimate goal with diversification is you don't want too much money in any one area. So if, let's just say that this mutual fund had 90% technology, and technology ended up taking a massive hit like it did in the early 2000s with the dot-com bubble, then that could be a major problem. So the ultimate goal here is to spread your money out across all of these sectors as evenly as possible. To give you another take on diversification, let's look at an ETF called SPY. Now, this portfolio right here tracks the S&P 500. And as I said before, technology is a little bit bigger, but communications isn't near as big. And a lot of the rest of this is pretty evenly cut. I mean, you do have some things like utilities, basic materials, and real estate that are a little bit smaller. But the ultimate goal is, again, to make sure that you're diversified. So be careful when you're looking at these mutual funds, because I'm starting to see more and more of those that aren't diversified as they should be. And also make sure that you know your risk tolerance to know what you're buying when you buy these. Now let's talk about performance. Now remember, I said if you invested $10,000, you would actually only invest $9,425. That is if you paid that front-end load fee. Now the nice thing about working with a fiduciary advisor is they do not take commissions. So instead of buying this on your own, if you did go and work with a fiduciary advisor, like I'd said, thefuturemill.com, you can do that. We will be able to actually invest in mutual funds for you within a portfolio without having to pay that front-end load fee. Now, are these mutual funds better because they have an active trader, or are they worse because they have a higher fee? Well, let's take a look at that and actually look at the specifics on this. And this fund that I talked about, this is the American Fund's Growth Fund. Now, they're both 100% stocks, the American Fund's Growth Fund and the SPY ETF, which looks more at the S&P 500. So if you're looking here at the 10-year return, the American Funds averaged 16.3%, SPY averaged 15.28%. Not a big difference overall, but if you actually look over a 10-year period of time, that does space them out quite a bit on the chart here. Now, if we want to look at a 20-year period, American Funds actually did 10%, SPY did 8.75. So then if you go back though to a 5-year period, American Funds are still beating them. Then we look at a 1-year period, S&P 500 is actually outperformed. So long-term, historically, it looks like up to 20 years, the American Funds has actually beat the S&P 500 with this fund. Though again, it's not all up to your risk tolerance. It's not always about just buying the right fund. Now, let me just be clear on this. This isn't a recommendation to buy any specific fund. I'm more of wanting to go into the details and educate you on these funds and how this works and how mutual funds work. Now, think about what I said with those front-end load fees, and let's take the performance of this American fund. Let's put it up against the S&P 500 tracker, which is the SPY ETF, and let's see if you invested in one versus the other, and one has the front-end load fee, how long it would actually take you to break even. Because I think that's going to be one of the biggest things on, is the mutual fund actually the world's worst thing, or are they sometimes something that's just not always the best for your portfolio? So let's take a look at that. Comparing the ETF SPY, which tracks the S&P 500, versus this mutual fund, the American Fund's Mutual Fund Growth Fund, it looks as though, because of performance, if you were looking at 10 years, it is going to take you 7 years to break even. Now, I'm looking at a 10-year performance window on this. So the American Funds, which is AGTHX, is a 16.3% return over 10 years. That's the average. Now, if you're looking at the SPY fund, it's 15.28%. Now, if you take the $10,000 you're wanting to invest, you pay the front-end load fee of $575. You're going to invest that for 7 years, and you're going to put a 16.3% interest return on that on average. it's going to get you $27,123.10. If you take $10,000 not having a front-end load fee, 7 years, 15.28%, then it looks like it's $27,056. So my take on this is that you want to be very careful when you are looking at mutual funds. Look at that front-end load fee. Remember, it could take you up to 7 years to break even just on that fee. Now you also want to look at the back-end fees on this, the management expense. We'll go to the Morningstar reports and look at that, because this management expense isn't that bad. The performance has done really well. So that's one take on this one. But what if you get into another mutual fund that hasn't performed as well over time? It may not be worth getting into that mutual fund versus actually just going with a more passive index fund or ETF fund. It's not a recommendation. This is just to educate you, but it gives you an idea. Now, if you made it this far, please be sure to like and subscribe. And if you are looking for a fiduciary advisor, we do not have minimums with the Future Mill. You can go to the Future Mill, you can book a call with us, or select your subscription. We're happy to help you. Thank you for watching.